Hi, everyone. Welcome back to our podcast, The Ins and Outs of Selling a Business. For those of you just joining us, my name is Keith Dee. I'm president of Osage Advisors. Osage Advisors is a boutique merger and acquisition firm working with business owners looking to sell, typically with $5 million in revenues and up. And we just celebrated our 21st year in business, so we've been around for a while. Anyways, thanks for joining us today. You know, I was thinking about what would be a good topic for these times. We are in a period of economic uncertainty, and I look back over our prior episodes, and I felt one area that we really haven't touched on is why deals don't get done, why they don't close. And I felt this would be a great time to kind of break it out and talk about it in reasons like, I have like 5 buckets of why deals don't get done. So I thought on this episode, we talk about reasons deals don't get done, and then we back it up with a part 2 and give some examples of how, you know, we kind of mended defenses and brought the parties back together to get the deal back on track. So number 1 in why deals don't get done is performance. You know, typically financial performance. Usually a buyer and a seller meet. The buyer gets some preliminary due diligence materials, a SIM, which is a confidential memorandum, known in trade as a book, that has a history of the business. It talks about the ownership. It talks about the team. It talks about the sales trends, the customers, the vendors, growth opportunities, etc. And also in the back of the book, it talks about, you know, the financial performance. So a buyer is going to submit their bid, or buyers will submit their bid based on the company's financial performance. So once you get into due diligence on that, when you choose a buyer and you're going through due diligence and, you know, say some things slip. One is if you were going to do $2 million of EBITDA or profits, and, you know, the buyer's going through it and certain things happen in the environment and your numbers are slipping. So instead of being $2 million, it's $1.8 million. So right there, the buyer maybe come back to you, look for a price adjustment. But you look at it from a business owner's perspective and say, hey, you know, at a 6 multiple, that $200,000 or $300,000, that's $1.5 million, $2 million to me. Do I really want to do this? So if your financial performance starts to slip a bit, that could be a reason that it could, you know, frankly, you know, kill the deal. Another area under performance, financial performance, you know, is trends. You know, buyers look at various trends. You could be performing great, your numbers are good, but they're looking at your trend lines, whether it's your product mix, whether it's, you know, your pipeline, whether it's stability of your backlog, for example. Say you run a typical backlog of $4 to $5 million, and the buyer's doing due diligence, and that backlog has slipped to $3 million. They're going to want to know why, right? So that could be an area where they're going to come back to you and say, hey, you know what? We're not comfortable right now, so we want to reevaluate the deal. Or they may walk away from the deal, or you may walk away from the deal. Another area under the performance is, you know, key performance indicators, you know, KPIs are called in trade. You know, it could be unit price per deal. It could be the number of units sold. I mean, when you look at private equity funds as a buyer, they do a deep dive into a lot of analytics. And if they see some changes and trends in your analytics, that could raise questions to them. And it comes back to you. And depending on how you resolve that, it could be a point where, hey, we're not comfortable moving forward. And they may walk from the deal, or you may walk from the deal. So again, we're just going to kind of go through why deals bust or break, but I just want to give you some examples. And again, we're going to talk about how we can resolve those issues between a buyer and a seller in our next episode. Another area under performance is financials, like working capital. You know, that's critical to how the business runs every day, right? It's the time where you invest money in a product or a service comes back to you in cash down the road. So a buyer is going to look at, you know, your working capital trends. Historically, we typically look at a 12-month trend, that the business is running continuously consistent with historic levels. And if there's some blips in that, one is, for example, today, we have supply chain issues. So a lot of companies are building inventories so they can mitigate any issues down the road with providing product to the customers. So they have a higher level of working capital now, and that is a bit of a challenge that has to be addressed when the buyer and the seller to be negotiated. And the seller is going to be adamant about it in a lot of cases that, hey, I got a lot of money tied up in inventory that I normally wouldn't, and I want to see some of that money as part of the deal, right? So those are some of the things in the performance end that could kill a deal, that could break a deal, that could cause either the buyer or the seller to walk. Another one is, your seller remorse. You've had a company 20, 30, 40 years, and you decide, you know what, I just don't want to do this deal. Not sure what I want to do with the rest of my life. I thought about it, and, thanks for coming by, but I just can't sell. It happens. It happens a lot. And we'll give you a few examples in our next episode of how we've kind of worked around that challenge or not. From a seller perspective, if you entertain a buyer directly without testing the market, sometimes that seller remorse is, is this the right number? Is this the right value? Am I getting the maximum value for my business? Is it the right deal for my people? That's kind of falls underneath that seller remorse bucket. Also, once you get into a sales process with a banker like Osage and you go through, say, a competitive auction process, the market's going to speak, right? What they like about your business, what they don't like about your business. And, we all work within our own, silos, so to speak. And so once eyes are open to opportunity and say, hey, you know what? I've learned a lot from this. If I kind of step back and implement some of these things, 3-4 years from now, my company could be worth so much more. So maybe I'm not going to sell now. Maybe I'm going to take what I've learned from this market, what I need to do to improve my results, and then go back to market at a future date, right? It happens a lot. That's one of those reasons why a deal may not move forward. And not every deal closes, right? I mean, we work very diligently. We work on our client's behalf. We put a tremendous amount of resources, but no firm out there closes every deal. There's certain things outside of your control that will end up, having the deal not close. It just happens. It happens to everybody, and it's just a fact of life when you're doing a transaction that certain things will happen that outside of your control, i.e. COVID, that will, put a deal on either stop the deal or put it on pause. Another one, speaking of COVID, is time. They say time kills all deals. Things can happen from the time you sign a letter of intent to the time you close. And if you don't work in a efficient manner towards closing, things can pop up that will cause either the buyer or the seller to say, look, I'm not moving forward to the transaction. We're done, right? And, it's in a stressful time. It's an emotional time. So as the environment changes from one to the other, things could happen that stop a deal. For example, you're dealing with in good faith with the buyer, and the buyer may not be dealing in good faith with you. They're working on your deal, but they have another deal in the back pocket they're also working on. And if that deal closes first, they're going to walk from your deal. So understanding the buyer you're working for is critical. But if you're not moving in a timely manner, that could cause the deal to basically put on pause or die, right? I mean, so you got to focus on the time, and you got to move diligently, professionally with your advisors to close. The management team or the family, so to speak. You put things in place for your business. You've hired the right person, you thought. Your family's behind you to get this deal done. But once you go on the letter of intent, people's expectations change, or they're looking for something more, or they're not up to the task. And, if that management team, whether it be a family member or an outside person you brought in, the buyer's perspective is that, you know what? I'm just not comfortable moving this company forward, this transaction forward with this person. I want you. And you're saying, well, if I'm going to stay in the business, I'm not going to sell it. Right? So, management as a whole is something that's looked at very deeply during the due diligence process, that you need to be aware of, that more from the buyer perspective, they're going to, if they don't feel comfortable, they may decide to walk. And in any case, that may not be the best buyer for you. You may have to go back to market down the road. I think the most important one is probably transparency. They used to say back in the day, honesty is the best policy. From our perspective, honesty is the only policy. And when a buyer and seller communicate, you have to have everything on the table at all times. From the seller's perspective, from your perspective, and also from the buyer perspective. That communication between the two of you is critical. I mean, you're just, once you just select a buyer and you start going through the due diligence process, it's like, you're kind of dating, to use an analogy, that you're going to, to become a marriage of their business and your business. And if you're not communicating totally in honesty during that process, it's going to raise a level of distrust or skepticism we've talked about in many podcasts in the past. And if you raise that level, either party may decide to walk away. And it could be a miscommunication that needs to be addressed, and we'll talk a little bit about that in our next episode of this, part of this podcast. But these are the type of things that can happen during the process. Everybody's working in good faith. Everybody's working towards a common goal, but things happen outside your control. Could be the seller, could be the buyer, could be the environment that cause a situation where a deal will not close. Now, it's not to say you can't get the deal done down the road, but in that specific transaction with that specific buyer, it may not work out. It happens. So, understanding your financials, your trends, being communicative, open about them, and we'll talk about, again, how we bridge those gaps, how you feel about it, why you were motivated in the first to sell the company, but then you're into this transaction process and emotions are flying and like, should I really be doing this? Understanding what your goals are, that you stay true to them so that some of these doubts, so to speak, are satisfied. So you move forward with the transaction. Working efficiently, timely, making sure you have information available, all parties working together, coordinated effort. Once the deal's on the table, the buyer and the seller work together to get the deal done to everybody's satisfaction. If time starts to slip, right, or there's a lack of, all of a sudden there's dead silence, right? The worst thing you could possibly have is somebody goes, quote unquote, radio silent during a transaction. That means something's up, right? It's our job as bankers is to reopen those line of communications. Okay, what's your concern, right? What's going on? So that time element, right? And your people, the management team, making sure that they're up to the task. And if they're not up to the task, how do you fill that void? And it may be that you need to fill that void in the short term. And we'll talk a little bit about that. So, these are the type of things that can, kill a deal, have it not close. And that happens. I mean, everybody out there who's a business owner has peers who they've dealt with that have gone through a process and it hasn't worked out for one reason or another. So these are some reasons, especially now during these difficult environmental time, economic times, is the things you need to think about, make sure, and prepare for so that we can smoothly move the transaction to close. I mean, it could be some choppy waters, but with open communication, and putting together ideas and structure and compromises, hopefully we can get to the point where we get the deal done. If not with this buyer, maybe we take the market down the road with another buyer. But that being said, these are some of the things that are what I would call the 5 main buckets of why things don't get done and why a deal may not close. And so what I like to do now is like we're going to kind of wrap things up here, but we're going to focus on the next part of this about how we can mitigate some of these issues that come up from both a seller and a buyer perspective, and kind of bridge those gaps, find compromise, and find a structure that will work for you and your family. Again, my name is Keith Dee. I'm President of Osage Advisors. You can find us on our website at osageadvisors.com. You can email me anytime at kdee@osageadvisors.com, or feel free to give me a call at 860-767-3273, extension 1001. Thanks for joining us today, and have a great day.